Imagine a company that's famous for landing a single robotic probe on the moon.
Right, like a very bespoke, golden foil wrapped science experiment.
Exactly, just a one-off. Now imagine that exact same company is secretly transitioning in the background, and they're building an assembly line to pump out like 70 defense satellites simultaneously.
Henry Ford style.
Yeah, literally Henry Ford style. And that is the Jarring Reality Intuitive Machines, ticker symbol LUNR, just revealed in their Q2 2026 earnings call. So welcome to this Talk Tickers edition of our Deep Dive.
Glad to be here.
Today we're looking at a financial and frankly an industrial pivot that completely shatters traditional aerospace valuation models. I mean, we're cutting through all the Wall Street jargon to give you, the listener, a fast, actionable breakdown of what this means for your portfolio.
Yeah, because a company that built its reputation on lunar deliveries has effectively announced they're building the roads, the cell towers, and the operating system for the entire new space economy.
It's wild. So let's jump straight into the headline numbers. Because before we talk about lunar landers, we really need to talk about the money.
Oh, absolutely. The numbers here are, frankly, difficult to contextualize if you only follow traditional manufacturing.
Right. So the top line explosion, $206 million in revenue for the second quarter.
Which is massive.
So the 4x jump. 4 times the revenue they reported in the exact same quarter last year.
Yeah, and if we were talking about like a software company, a 4x jump means they just spun up some more AWS servers, right? Or they ran a really great marketing campaign.
Yeah, exactly. Software scales instantly.
But in aerospace hardware, quadrupling your revenue year over year implies a fundamental rewiring of your entire supply chain.
And the factory floor.
Right, the factory floor, your delivery cadence, the physical reality of generating $206 million in a single quarter in this sector. I mean, it means metal is moving out the door at just an unprecedented rate.
So it wasn't just some accounting trick or, a one-time intellectual property sale.
No, not at all. It was driven by pure execution across 3 really distinct physical divisions.
Okay, break those down for me.
Sure. So first, you have their newly acquired satellite manufacturing division, which is really hitting its stride. Then you have the commercial lunar payload services.
The CLPS missions for NASA, right?
Exactly. The CLPS missions, those are moving past the design phase and into actual physical hardware integration. And then third, you have their near space network services coming online.
Wow. So they're hitting actual physical milestones laid out in their government contracts.
Yeah. They are recognizing that revenue because they are physically delivering.
Which brings us to the margin check. And this is where the financial engineering gets almost as interesting as the aerospace engineering.
Oh, for sure. The gross profit turnaround is insane.
Right. So let's look at it. The gross profit for the quarter landed at $36 million. Now, to the untrained eye, $36 million might seem quaint compared to big tech.
Sure. Apple makes that in a few minutes.
Yeah. But context is everything here. Because last year, in this exact same quarter, their gross profit was negative $12 million.
Right. They went from losing $12 million just on the raw cost of goods sold to generating $36 million in positive gross profit.
That's a $48 million swing just in the core economics of building their products.
And crossing that chasm, from negative to positive gross margin in hardware manufacturing, it's probably the most dangerous phase of a company's life cycle.
I've heard it called the Valley of Death.
Yes, exactly. The Valley of Death. Because when you're building prototypes, like their initial Nova-C lunar lander, every single part is custom machined. Every software script is written from scratch.
So the non-recurring engineering costs just crush you.
They absolutely crush your gross margin, yeah. So flipping to a $36 million positive margin indicates they've finally standardized their production.
They aren't inventing the wheel every single time they sign a contract.
Right. They're pulling the wheel off the shelf and just attaching it to the chassis.
Okay, I see the bullish momentum there, but I'm going to play devil's advocate for a second. I'm going to pump the brakes and take the bearish angle on this trade.
Go for it.
Because a $48 million swing in gross profit is fantastic, but when I scroll further down the Q2 release, I run into a brick wall.
You're looking at the operating loss?
I am. The operating loss for the quarter was $47 million. And their adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, was negative $14 million.
Right.
So despite all this scale, all this standardization, the core operation is still losing money. Why should an investor look past a nearly $50 million operating loss?
Well, because taking that operating loss at face value kind of ignores the underlying mechanics of aerospace accounting and, frankly, the deliberate investments they're making.
Okay, unpack that for me, because negative 14 million is still negative.
True. But let's dissect that negative 14 million adjusted EBITDA first. Last year, that number was negative 25 million.
Oh, okay. So the actual operational cash bleed improved by 11 million year over year.
Exactly. It shows a clear trajectory toward profitability. But the real culprit keeping that specific number in the red is a highly specific mechanism in government contracting called an EAC adjustment.
The estimate at complete adjustment.
Right. The CFO, Pete McGrath, noted a $14.7 million EAC adjustment specifically tied to their IM-4 lunar mission.
Let's translate that into plain English for everyone listening, because an EAC adjustment essentially means they looked at a project they're currently building and they realized the total cost to finish it is going to be way higher than they originally budgeted.
Yes. And accounting rules force them to take that entire financial hit on the books right now instead of spreading it out over the rest of the project.
Wow, so it all hits in Q2. But what caused that massive spike in costs for IM-4?
The catalyst for that adjustment actually reveals a lot about the realities of spaceflight. The customer changed the payload parameters for IM-4.
And the payload is the actual scientific cargo going to the moon.
Right. So when a customer swaps out a sensor or, adds a new rover, or even just changes the mass distribution of the cargo, you can't just strap a new box to the lander and call it a day.
I'd imagine not.
It requires complete re-engineering. It alters the center of gravity, which means you have to rewrite the flight dynamics software.
Oh, wow.
Yeah, and it requires entirely new thermal testing to make sure the new payload doesn't freeze or fry in the vacuum of space.
Okay, I like to think of it like building a custom house.
Yeah.
And halfway through framing the house, the client decides they want to add a commercial-grade indoor swimming pool on the second floor.
That is a perfect analogy, yeah.
Because you have to tear up the plumbing, reinforce the foundation, totally change the electrical load.
Exactly. So Intuitive Machines had to shift elite engineering resources over from their nearly completed IM-3 mission to handle the redesign on IM-4, and that caused that $14.7 million spike in costs.
Which means, if you factor out that one-time customer-driven redesign, their adjusted EBITDA is basically sitting at a break-even point.
That's the key takeaway right there. But we also have to address the SG&A.
The selling, general, and administrative expenses, which came in at a seemingly elevated $60 million for the quarter.
Yeah, but that number is heavily distorted by their recent aggressive expansion. Included in that $60 million is $11 million in share-based compensation.
Because keeping top-tier aerospace engineers from jumping ship to SpaceX or Blue Origin requires equity.
Exactly. It's a brutal talent market. Furthermore, you have $8 million in transaction and integration costs related directly to the companies they just acquired.
Because when you buy a company, you have to merge the IT systems,
right?
Align the HR departments, integrate the supply chains.
It's an upfront cash incinerator.
Right. And the CFO was adamant that if you strip out those integration anomalies and those retention stock units, the baseline operating expenses are holding steady. They aren't bloated, they're just swallowing the cost of their own hypergrowth.
Which leads us to the single most important metric in this entire earnings report. You can fret over the EAC adjustments all day, but the actual value of an aerospace contractor is dictated entirely by its backlog.
And their backlog is just mutated into a monster.
It really has.
They exited the second quarter with approximately $1.8 billion in contracted backlog. I mean, just to put the sheer velocity of that number into perspective, they generated $1.7 billion in new bookings just in this calendar year.
With $1.2 billion of that flooding in during the second quarter alone.
Yeah. A $1.8 billion backlog for a company this size fundamentally alters their negotiating power with suppliers and obviously their risk profile for investors.
And we need to be clear about what backlog means here. This is not a pipeline of potential deals or like a wish list of letters of intent.
Right. It's not a sales funnel.
No. In this industry, backlog represents signed, definitized contracts or highly mature task orders where the federal government or a commercial client has formally committed the funds.
So when a company manages to generate $206 million in a single quarter, yet their backlog still swells to $1.8 billion, it tells you the market's demand is vastly outpacing even their quadrupled production rate.
They are drinking from a fire hose. And that fire hose is driven by the strategic pivot we mentioned earlier. Let's talk about this space prime strategy.
Yes, Section 2, the story behind the numbers. because understanding this concept is really the key to understanding how a lunar lander company secured nearly $2 billion in future work.
Right. So the term prime contractor carries immense weight in the defense and aerospace sectors. Historically, the prime contractor club is an oligopoly.
You're talking about Lockheed Martin, Boeing, Northrop Grumman, General Dynamics.
Exactly. The prime is the entity that wins the massive multi-billion-dollar federal contract to deliver an entire system of systems. They manage the overarching program, they integrate the final technology, and they farm out the smaller components to a vast network of subcontractors.
And for the first few years of its existence, Intuitive Machines was effectively a subcontractor, or at best, a very niche prime for a single, small-scale scientific delivery.
They built the delivery truck.
Right, a highly complex truck that goes to the moon, sure, but a truck nonetheless. And management realized that the real enterprise value isn't in building the truck.
No, the real value is in building the highway, managing the traffic control system, and operating the toll booths.
I love that analogy. And CEO Steve Altemus coined the term next generation space prime to signal their intent to elevate to the top of the food chain across the entire ecosystem.
Right. Low Earth orbit, geosynchronous orbit, cislunar space, and deep space. The strategy to achieve this prime status is built on three distinct pillars that management really hammered on during the call.
Build, connect, operate.
Exactly. Let's break down the build pillar first, because you cannot be a prime contractor without possessing massive scaled manufacturing capabilities. You can't outsource the core bus of your architecture.
To solve that, Intuitive Machines went on a highly calculated shopping spree over the last 18 months, didn't they?
They did. They acquired a company called Lanteris, which instantly transformed them from a boutique lunar lander shop into one of the most prolific satellite manufacturers in the nation.
They didn't just buy some interesting patents, right? They bought hot, functioning production lines.
Yes. And the scale of those production lines is what separates them from the legacy space industry. The legacy model of satellite manufacturing involves like a massive clean room where hundreds of scientists spend 5 to 10 years building one giant school bus-sized satellite.
That costs $2 billion.
Right. It's a battleship mentality.
Okay.
But the new space economy, driven heavily by the Space Development Agency, or SDA, has pivoted to proliferated constellations.
So instead of one massive satellite that an adversary can shoot down with a single missile, the military wants a web of 300 smaller, cheaper satellites.
Exactly, because if one gets knocked out, the network heals itself. And Intuitive Machines is perfectly positioned for that exact pivot. They revealed on the call that they currently have over 70 IM-300 series spacecraft in simultaneous production.
70 spacecraft being built at the same time. That is where that Henry Ford assembly line analogy really comes into play.
Yeah, it's wild. And IM-300 series is their standardized bus for low Earth orbit. The CFO made a fascinating point about the economics of this bus, actually.
What was that?
The bulk of the non-recurring engineering costs, the expensive R&D required to figure out how to mass produce this specific chassis, was effectively paid for and retired during their first delivery of 16 satellites to the Space Development Agency for the Tranche 1 tracking layer.
Okay, let's explain the tranche system for the listener, because it's exactly how the Pentagon buys space hardware now.
Right.
Instead of defining a perfect system and waiting 10 years for it, the SDA buys in batches or tranches every 2 years. So they accept iterative technological improvements.
Exactly. Intuitive Machines cut their teeth and paid down their R&D on Tranche 1. Now they are reaping the margin benefits.
Because they're building 18 satellites for Tranche 2, they secured another 18 for Tranche 3, and they were just awarded another 18 satellites for the AMDT-3 program.
Which is a critical piece of the nation's Golden Dome missile defense architecture, by the way. They have achieved high commonality across the bus.
And when you have high commonality, your supply chain becomes exponentially cheaper.
Right. You're ordering reaction wheels, star trackers, and solar arrays in batches of 100 instead of batches of 2. That drives down the unit cost and drives up the gross margin.
Which is exactly why we saw that $48 million positive swing earlier.
Exactly.
But the build pillar isn't just restricted to low Earth orbit. The transcript casually drops the fact that they are also manufacturing the larger IM-1300 series satellites for geosynchronous orbit, or GEO.
Right, and GEO satellites sit much further out, roughly 22,000 miles above the Earth, matching the planet's rotation. They are the heavy lifters of the communications world.
And Intuitive Machines announced they won an undisclosed commercial contract to build 3 of these GEO satellites valued at over $600 million.
A $600 million commercial contract for just 3 satellites. That single contract is worth 3 times their entire Q2 revenue.
Wow.
It proves that their manufacturing capability is entirely agnostic to the orbit or the customer. They can build small LEO trackers for the Pentagon and massive GEO relays for commercial telecom.
So they have the build killer absolutely locked down. They have the factories, and they are churning out spacecraft at an astonishing rate. But building the hardware is only 1/3 of the space prime equation. We need to examine the connect and operate pillars.
And this is where their other strategic acquisitions really come into play. They acquired a company called Kinetics.
Okay, and what does Kinetics do?
They provided advanced mission operations software, flight dynamics algorithms, deep space precision navigation, and constellation management tools.
Because once you eject a satellite out of a rocket fairing in low Earth orbit, it's essentially a brick tumbling through space until the software takes over.
That's exactly right. Kinetics gives them the proprietary operating system to detumble that rook, deploy the solar panels, calculate the exact orbital trajectory, and fly the satellite for the next 10 years.
And managing a proliferated constellation of 70 satellites requires incredibly sophisticated automated flight dynamics, I would assume.
Oh, absolutely. You have to manage collision avoidance, orbital decay, and encrypted data routing. So by owning the software layer through Kinetics, Intuitive Machines isn't just selling the hardware to the government and walking away.
They're retaining the capability to operate the fleet.
Right. Which brings us to the Connect pillar and the physical reality of how you talk to a spacecraft.
Because you can have the best satellite and the best software in the world,
Yeah.
but if you can't beam the data back to the Pentagon or NASA, the whole system is useless.
Exactly. So they acquired Goonhilly Earth Station in the UK and ComSat in the US. The ground segment is often the most overlooked bottleneck in the entire space economy.
Well, yeah. Communicating with an object 250,000 miles away on the moon involves fighting the inverse square law of electromagnetic radiation. The signal degradation has to be massive.
It is massive. You need enormous, highly sensitive parabolic dishes to catch the whisper of a signal from a lunar lander.
So by acquiring Goonhilly and ComSat, Intuitive Machines inherited a global network of massive satellite dishes.
And they are actively upgrading them too. The transcript mentions they're installing new tri-band antenna feeds in places like Catawissa, Pennsylvania.
Tri-band feeds, meaning what exactly?
It means a single dish can simultaneously communicate across different frequency bands, S-band, X-band, and Ka-band. It drastically increases the bandwidth of data they can pull down from orbit.
Got it. So when you combine all 3 pillars, build, connect, operate, you achieve a true system of systems architecture.
Exactly. They build the LEO satellite on their Lanteris assembly line. They launch it. They fly it using their Kinetics software. They download the sensor data using their own ComSat ground stations in Pennsylvania.
They own every single link in the value chain.
That is the definition of a prime contractor. And it gives them unprecedented pricing power and margin control.
However, building out this vertically integrated end-to-end prime architecture requires a terrifying amount of upfront capital. Which brings me to my biggest area of pushback.
Let's hear it.
We have to confront the cash burn, because the numbers here could easily spook a retail investor.
Sure.
In Q2, Intuitive Machines used $60 million in operating cash, and they deployed $24 million in capital expenditures, or CapEx.
Right.
That is an $84 million cash deployment in a single 90-day period. For a company that ended the quarter with $367 million in the bank, burning $84 million is a ferocious run rate.
It definitely is.
Are they expanding too fast? Should investors be worried about a liquidity crisis?
It's the right question to ask, honestly. And it requires understanding how capital allocation works when you're trying to capture market share in a hyper-growth industry.
Okay, sell me on it.
If you listen closely to how the CFO justified this cash bleed, it becomes clear this is a highly calculated risk. They're intentionally burning cash to invest in long-lead inventory and physical infrastructure ahead of customer demand.
Okay, investing ahead of demand sounds great in a corporate slide deck, but what does that actually look like on the factory floor in aerospace?
Well, in the legacy aerospace model, a company would spend 3 years lobbying for a government contract. Once the contract is finally awarded, signed, and the first milestone check clears, then the company picks up the phone and orders the aerospace-grade aluminum, the radiation-hardened microchips, and the titanium fasteners.
The problem being, the supply chain for space-rated components has massive lead times, right?
Huge lead times. You might wait 18 months just for a specific gyroscope to be manufactured.
And the modern space race doesn't have time for 18-month lead times. The customer, whether it's the Space Force or NASA, wants greater production volume and they want it delivered yesterday.
Exactly. So to meet that demand and win the contracts, Intuitive Machines is front-running the procurement process. They spent $17 million in the quarter solely on accelerated inventory and infrastructure to support anticipated programs.
So they aren't waiting for the ink to dry on the final contract definitization. They know the demand is coming, so they're buying the core chipsets and long lead materials right now.
Right. For instance, they're actively purchasing the hardware for satellites 2 through 5 of their lunar communication constellation before the final launch manifests are even locked in.
By taking on that inventory risk, they compress their delivery timeline.
Which is brilliant. If the Pentagon issues an urgent requirement for a new tracking satellite, a legacy prime might quote a 48-month delivery schedule because they have to wait for parts.
But Intuitive Machines can look at the Pentagon and say, we already have the titanium chassis and the radiation-hardened chips sitting in our warehouse in Houston. We can deliver in 24 months.
Exactly. That speed is the ultimate competitive advantage, and it's what wins the $1.8 billion backlog. The CapEx spend is similarly aggressive and forward-looking, by the way.
Right. A large portion of that $24 million CapEx went toward building out an additional 75,000 square feet of manufacturing space at their facility in Houston.
Because you can't build heavy cargo lunar landers and fleets of defense satellites in a cramped garage. You need massive clean rooms, thermal vacuum chambers, and vibration testing tables. They are building the factory to support the backlog.
They also discussed a major shift in how their contracts are structured, which is supposed to alleviate this cash burn going forward.
Yes. Historically, they relied on bespoke milestone payments. They would hit a technical review and NASA would send a check. But those payments were often lumpy and disconnected from their major expenses.
Like in Q2, where a massive $17 million milestone payment to SpaceX for the IM-4 launch vehicle hit their books, which violently drained their cash position.
Right. And the CFO noted a strategic correction here. Their new commercial lunar payload services contracts, specifically the CS-8 and CT-4 missions, have completely restructured payment milestones.
So these new contracts are designed to provide a more regular cash flow cadence that aligns perfectly with their major outflow events.
When the bill from SpaceX comes due in the future, the corresponding check from NASA will be timed to hit the account simultaneously, smoothing out the working capital requirement.
Which is huge. But we cannot discuss their liquidity without addressing the elephant in the room, the ATM program.
Let's get into it.
To fund this aggressive expansion, Intuitive Machines utilized an at-the-market stock offering program during the quarter, which means they raised $235 million in net proceeds by essentially selling new shares of their stock directly into the open market at an average price of $26.81.
And retail investors notoriously flinch at the mention of ATM programs because it represents direct dilution. You are issuing more shares, which means every existing shareholder now owns a slightly smaller percentage of the overall company.
The pie is being sliced into thinner pieces.
Exactly. But the counter-argument and the reality of the specific situation is that the pie itself is growing exponentially because of this exact capital raise.
Right. If a company uses an ATM to keep the lights on and pay executive salaries while revenue shrinks, that is toxic dilution.
100%.
But if a company uses an ATM to raise $235 million and then immediately deploys that capital to build a 75,000 square foot factory and pre-buy inventory that allows them to win a $1.8 billion backlog.
That is highly accretive dilution. The CFO explicitly stated that their resulting $367 million cash balance provides the necessary liquidity to fully fund their current operations and execute on this massive backlog.
They are not in a distressed position.
No, not at all. They've fortified their balance sheet at an advantageous stock price, giving them the war chest required to scale up to the prime level. Management expects their free cash flow profile to dramatically improve throughout the second half of the year.
Because these heavy initial infrastructure investments will stabilize, and the milestone receivables from all these newly awarded contracts will start rolling in.
Which brings us to management guidance, right? Because the narrative of aggressive vertical integration is fully funded. They bought the supply chain, standardized the product lines, pre-bought the materials, built the factory.
But those massive capital deployments only make sense if the underlying demand from the government and commercial sector actually materializes into recognized revenue.
Yeah.
So what exactly is management projecting for the remainder of 2026?
The guidance provided on this call is where the conviction of their strategy really shines. Because despite the heavy cash burn in the first half of the year, management confidently reaffirmed their full year 2026 revenue guidance.
And what was that number?
$900 million to $1 billion.
$1 billion. We really need to pause and absorb the velocity of that projection. We are talking about a company that just reported $206 million for the second quarter.
Right.
To hit the high end of their guidance, they are projecting a massive acceleration in recognized revenue over the next 2 quarters. I mean, sticking to $1 billion projection requires immense confidence in their operational execution.
And their supply chain integrity, yeah. But the foundation of that confidence is the $1.8 billion backlog. The CFO provided a critical metric during his prepared remarks.
Which was?
He stated that approximately 25% to 30% of their current Q2 backlog is expected to physically convert into recognized revenue within this calendar year.
Okay, let's run that math. 30% of $1.8 billion is $540 million. So they have roughly $500 million in guaranteed contracted revenue already locked in the backlog that will flow through the income statement before the end of 2026.
Exactly. Now, during the Q&A session, an analyst from B. Riley Securities pushed back on this exact calculation.
Oh, I saw that. The analyst astutely pointed out that if you take the revenue already generated in the first half of the year and add the $540 million expected to convert from the backlog, you arrive at the low end of their guidance, around $900 million.
Right. So the analyst asked, what is the specific swing factor that gets them to the $1 billion high end of the range?
And the answer to that question reveals an upcoming catalyst that is arguably more important than the current backlog. Management cited their partial awards with authority to proceed, or ATPs.
Let's unpack the mechanics of an authority to proceed because it is a vital quirk of government contracting.
Yeah, please do.
An ATP is essentially a flashing green light from the federal government. It means the company has won the bid, the contract has been awarded, and the government desperately wants the work to begin.
However, the final granular legal terms, a process known as definitization, are still bogged down in bureaucratic negotiations between lawyers.
Exactly. The government knows that if they wait for the lawyers to finalize the exact payment schedule for every single bolt and line of code, the satellite will be delayed by a year.
So the contracting officer issues an ATP. Is the government saying, we are unequivocally hiring you to build this multi-billion-dollar architecture. The final paperwork will follow, but here is initial funding so you can go pour the concrete and order the titanium today.
Right. And Intuitive Machines disclosed that they anticipate these current ATPs will fully definitize and convert into an astonishing $3 billion in new bookings throughout the second half of the year.
$3 billion in pending government-authorized work. I mean, if you take their current $1.8 billion definitized backlog and add the pending $3 billion in ATPs, you are suddenly looking at a $4.8 billion pipeline of work.
For a company that was basically viewed as a niche science experiment 18 months ago.
It's unbelievable.
And this is exactly what the CFO meant when he discussed the variables in their guidance. The primary variable determining whether they hit $900 million or $1 billion isn't a question of demand. It isn't a question of whether the Space Force or NASA wants the hardware.
The demand is unequivocally there.
Right. The sole variable is bureaucratic timing. It simply depends on which month the government lawyers finish definitizing those ATP contracts, allowing Intuitive Machines to move the funds from the pending column into the recognized revenue column.
So if the paperwork slips to January, they hit $900 million. If it clears in November, they hit $1 billion. But the underlying economic reality remains exactly the same.
Precisely. And while top-line revenue growth is practically guaranteed by the backlog and ATPs, management also reaffirmed their guidance regarding profitability.
They continue to project positive adjusted EBITDA for the full year, meaning they expect the margins from these massive production runs to outpace their operating expenses in the back half of the year.
Yes, allowing them to climb out of the negative $14 million hole from Q2 and finish the year in the black on an adjusted basis.
The sheer volume of demand driving this guidance becomes even more apparent when you analyze the pipeline of upcoming contract decisions they detailed during the Q&A segment.
Oh, the executive team outlined a multi-front campaign to secure massive federal programs across both civil and national security space.
Let's dive into those specific programs because the details illuminate just how entrenched they are becoming in the federal space architecture.
Let's do it.
So on the civil space side, primarily NASA, they're expecting to compete for 4 additional commercial lunar payload services, or CLPS task orders, before the end of the year.
Right. 2 of those are landed missions, with the draft requests for proposals expected to hit the street this summer. They're also bidding on an orbiter surveyor mission designed to map the lunar surface in high definition, replacing the aging Lunar Reconnaissance Orbiter.
But the true white whale on the civil side is the upcoming CLPS 2.0 program.
Yeah, the CEO provided some staggering context for this program. CLPS 2.0 is estimated to be an indefinite delivery, indefinite quantity, or IDIQ contract valued at over $10 billion.
$10 billion. An IDIQ contract is the holy grail of government procurement.
It really is. It's essentially a massive federal hunting license. The government sets aside a colossal pool of money, in this case $10 billion over 10 years, and approves a small, exclusive list of vendors.
Those vendors then get to compete against each other for specific task orders drawn from that $10 billion pool, effectively locking out any new competition for a decade.
And Intuitive Machines built their entire business on the original CLPS 1.0 program. CLPS 2.0 represents a 4x increase in total contract value, driven entirely by NASA's need for heavier cargo landers to support human habitats on the moon.
And to capture that massive CLPS 2.0 funding, Intuitive Machines is actively evolving their hardware. I mean, their current Nova C-class lander is an incredible machine, but it is designed for relatively light scientific payloads.
Right. The CEO discussed their transition to the Nova D class lander, which is significantly larger and capable of carrying 500 kilograms of cargo to the lunar surface.
Furthermore, they're investing in advanced engine technologies, specifically exploring electric pump-fed engines to eventually scale up to a lander capable of delivering 5 metric tons.
And that heavy lift capability is a prerequisite for competing for the Lunar Terrain Vehicle, or LTV program, which represents another $4.5 billion opportunity to build essentially an unpressurized rover for Artemis astronauts.
Wow. And their ambitions are no longer constrained to the moon either. They are aggressively moving into terrestrial network infrastructure.
Yeah, management mentioned they are bidding on the commercialization portion of NASA's Tracking and Data Relay Satellite System, known as TDRS.
TDRS is a legacy network of massive communication satellites that NASA has used for decades to talk to the Space Shuttle and the International Space Station, right?
Yes, and NASA wants to privatize and upgrade this network using modern Ka-band frequencies.
So if Intuitive Machines wins a piece of the TDRS commercialization, they effectively become the AT&T of Earth orbit, providing the primary data backbone for all U.S. government spaceflight.
It's massive, and the defense opportunities are arguably even more lucrative. The CEO specifically named a classified program called Andromeda, also referred to as RGXX.
What is that?
This program involves building highly maneuverable geosynchronous orbit satellites for national security space.
Okay. Highly maneuverable GEO satellites are basically the defining weapon systems of the new space domain, because in geosynchronous orbit, satellites are traditionally large, slow, and predictable.
And the Space Force realizes that predictability is a massive vulnerability against adversaries with anti-satellite capabilities. They need agile, maneuverable platforms that can change orbits rapidly, inspect other satellites, and evade threats.
So winning a prime contract for RGXX would cement Intuitive Machines at the bleeding edge of Space Force doctrine.
Exactly, and an analyst from Canaccord Genuity picked up on this defense pivot and asked specifically about their ability to support Space Force programs with their newly acquired assets.
And what did the CEO say?
He confirmed that they are in active, high-level discussions in both the U.S. and the U.K. to utilize their Goonhilly and ComSat ground stations to provide space domain awareness data.
Space domain awareness, that's essentially the radar system for orbit, right?
Yes. The Space Force needs constant, high-fidelity data on every piece of debris and every adversary satellite in orbit. Intuitive Machines is positioning their ground stations as the primary downlink for this critical intelligence.
So the aggregate picture painted by this guidance is just overwhelming. You have a massive $3 billion wave of imminent contract definitizations hitting in the second half of the year, backed by a pipeline of multi-billion-dollar, decade-long federal programs where Intuitive Machines is already operating as an incumbent player with fully funded, scaled production lines.
It's a textbook prime contractor setup. Which brings us to the bottom line, Section 4. We have analyzed the revenue, the margins, the strategy, and the guidance. What is the actionable takeaway for you, the investor, looking at this stock?
The most actionable takeaway is recognizing how fundamentally the risk profile of Intuitive Machines has been rewritten over the last 12 months. I will take a very clear, opinionated, and bullish stance here, based strictly on the data provided in this call.
Let's hear it.
A year ago, investing in this stock was a binary, almost terrifying bet. You were wagering capital on whether a single experimental robotic probe would survive the descent to the lunar surface. If the engine failed, or the navigation software glitched and it crashed into a crater, the entire investment thesis was in jeopardy.
That's true. It was extremely high risk.
But today, the company has completely decoupled its fate from the success or failure of a single NASA science mission.
And the composition of their $1.8 billion backlog proves that decoupling beyond any doubt. The backlog is incredibly well diversified and balanced against macroeconomic shocks.
Give me the breakdown.
Currently, 37% of their backlog is tied to civil space, meaning NASA. 49% is tied to commercial space contracts, and 14% is dedicated to national security space.
So the momentum is violently trending toward the commercial and defense sectors.
Yes. The CFO noted that the new bookings they secured in the second quarter were composed of 50% commercial contracts and 30% national security contracts.
They are no longer a one-trick pony reliant on NASA's fluctuating budget. If Congress slashes NASA funding, Intuitive Machines falls back on their massive defense contracts.
Right. And if the defense budget slows down due to macro pressures, they fall back on their commercial GEO satellite manufacturing. They have built a diversified, all-weather space conglomerate.
But the true long-term thesis for a shareholder, the catalyst that justifies premium valuation multiples in a market, isn't just their ability to sell massive quantities of hardware.
No, it is their strategic shift toward high-margin, recurring revenue models.
This is the holy grail for any industrial manufacturer. I mean, you do not want a business model where you just sell the tractor, record the revenue, and never see the customer again.
Right. You want to sell the tractor at a slight margin and then mandate a monthly subscription to the proprietary GPS routing software that the farmer needs to operate the tractor.
Exactly. And Intuitive Machines refers to this transition as infrastructure as a service.
The ultimate manifestation of this infrastructure as a service model is their Lunar data relay architecture. To understand the economic power of this architecture, you really have to understand the geography of the new space race.
Okay, let's break that down.
NASA's Artemis program and the competing international efforts are entirely focused on the lunar South Pole.
Because that is where the water ice is located?
Yes. And water ice can be processed into rocket fuel, making the South Pole the strategic high ground of the solar system.
But the problem with the lunar South Pole is the physics of communication.
Exactly. Because of the angle of the moon and the deep craters at the pole, you do not have direct line-of-sight communication with Earth.
So if you land a rover or an astronaut in a crater at the South Pole, they cannot radio Houston directly.
Yeah.
The signal is blocked by millions of tons of lunar rock.
You absolutely require a data relay satellite orbiting above the moon to bounce the signal from the crater up to the satellite and back to Earth.
And initially, Intuitive Machines plan to slowly deploy a constellation of these communication satellites over the next 5 to 7 years, having them ride shotgun as secondary payloads on their various lunar lander missions.
Right, but the demand signal from NASA is so acute that on this call, management announced a massive acceleration of that timeline. They are pulling their deployment schedule forward by years.
They will launch their first dedicated communication satellite, Altus 1, in the first quarter of 2027.
And more importantly, they negotiated with NASA for a dedicated launch vehicle that will fly satellites 2, 3, 4, and 5 all simultaneously in 2028.
So by the time the Artemis astronauts are scheduled to touch down, Intuitive Machines will have a complete operational 5-satellite communications network blanketing the moon.
And the monetization strategy for that network is just brilliant in its simplicity. They are not selling the satellites to NASA, they own the satellites.
They're going to charge users on a pay-by-the-minute data relay model.
Yes. The CEO cited an initial bid of about 500,000 minutes a year as a baseline government requirement.
It is literally a cell phone data plan for the moon.
Yeah.
But that 500,000 minutes is just the floor.
Oh, yeah. As the lunar economy expands, anyone operating on the far side of the moon or at the South Pole, whether it's a NASA astronaut, a European Space Agency science probe, or a commercial mining rover, will have no choice but to buy data packages from Intuitive Machines to transmit their high-definition video and telemetry back to Earth.
And in addition to the pay-by-the-minute data routing, they are providing a PNT broadcast: position, navigation, and timing.
It is effectively lunar GPS. Rovers and landers need to know exactly where they are on the surface to avoid hazards. Intuitive Machines will provide that constant PNT signal as an always-on service, subsidized and supported by government contracts.
That represents recurring, high-margin revenue flowing into their income statement every single month, regardless of whether they ever build another physical lander.
Because hardware manufacturing traditionally carries tight, single-digit margins because of the massive capital required for factories and materials.
But software, data routing, and infrastructure services carry massive, tech-like margins. By transitioning to an infrastructure-as-a-service model, Intuitive Machines is setting the stage for massive margin expansion over the next decade.
It's the Amazon Web Services model applied to cislunar space. Amazon started by selling physical books with terrible margins. They realized they had built an incredible back-end server infrastructure to run their store, and they pivoted to renting out that infrastructure to other companies.
Which now drives the vast majority of Amazon's profit.
Exactly. Intuitive Machines built lunar landers, realized they needed a massive communications and ground station architecture to support those landers, and they are now pivoting to rent that architecture to the rest of the space economy.
So let's rapidly summarize the 3 pivotal takeaways you need to remember from this deep dive into the Q2 2026 earnings call.
Number 1.
Top-line revenue is exploding, up 4x year over year, driven by scaled assembly line manufacturing that has successfully dragged their gross margins out of the valley of death and into the positive.
Number 2. The backlog has mutated into a record $1.8 billion behemoth, with a staggering $3 billion in ATPs pending definitization in the second half of the year, virtually locking in their path to $1 billion in annual revenue.
And number 3, they are aggressively and successfully executing the Space Prime strategy, vertically integrating their supply chain through key acquisitions and transitioning their core business model from bespoke hardware delivery to high-margin recurring infrastructure as a service.
Deeply insulated by diversification across civil, commercial, and defense sectors.
It is, without hyperbole, a fundamentally different corporate entity than it was 18 months ago. We are watching the real-time construction of an aerospace giant.
The speed of the pivot is what is truly breathtaking. They recognize where the margin is in the new space economy, and they deployed capital ruthlessly to capture it.
Which brings us to our outro. I want to leave you with a final provocative thought based on a very brief, almost overlooked exchange near the very end of the Q&A segment.
Yes, the Golden Dome question.
An analyst asked CEO Steve Artemis about their current work on the AMDT-3 Golden Dome satellites for national security. Right now, on that specific program, Intuitive Machines is operating as a subcontractor.
Right. They use their Lanteris assembly line to build the metal bus, the chassis, the solar panels, and the propulsion system. Then they hand that finished bus over to a giant traditional prime contractor like L3 Harris or Lockheed,
who installs the highly classified secret sensors on it and sells the final package to the Pentagon.
It is the traditional aerospace hierarchy. The established prime captures the lion's share of the profit margin for acting as the system integrator, while the subcontractor gets a fixed fee for bending the metal.
But the CEO essentially looked at the analyst and said, "Watch us." He outlined a near future where Intuitive Machines leverages their massive scale and new acquisitions to bypass the legacy primes entirely and bid as the prime contractor on these multi-billion-dollar national security payloads.
The value capture in that scenario is exponential.
Consider what happens to the theoretical ceiling of this stock if they successfully own the entire loop.
It's massive.
Imagine a scenario where Intuitive Machines doesn't just build the metal box. They build the advanced optical sensors. They launch the satellite. They fly the constellation using their proprietary kinetic software.
They beam the raw intelligence data down from orbit through their own ComSat Earth stations in Pennsylvania and the UK.
And then, crucially, They run the analytics on that raw data themselves and sell the final actionable digital terrain maps or missile tracking alerts directly to the Pentagon as a subscription service.
They eliminate every single middleman in the defense space architecture.
It is the difference between being Foxconn, earning a tiny margin assembling the physical iPhone, and being Apple, capturing the massive margins by selling the iPhone, running the App Store, and charging for the iCloud storage subscription.
Exactly.
If Intuitive Machines truly achieves that level of end-to-end prime integration, how deep does their competitive moat in the new space economy actually become? Because when you step back and look at the financial landscape we mapped out today, this isn't just an earnings report tracking a plucky science experiment anymore.
No, it's the financial blueprint for a permanent, vertically integrated highway to the stars.
And the toll booths are officially built, powered on, and open for business. Something to heavily mull over as you review the aerospace allocations in your portfolio. Thanks for taking the deep plunge with us today. Keep your eyes on the horizon, ignore the short-term noise, and we will catch you on the next deep dive.